Princeton.
Welcome everybody to this lecture today, and we would like to welcome Dan Tarullo, one of our most important policymakers in the United States. He is a financial regulation Czar, and before he became the financial regulation Czar, appointed by the Federal Reserve Bank as one of their key governors by former President Obama. He was also working in the White House at the NEC with President Clinton, former President Clinton, and also in the State Department before. And Dan is also a former law professor at Harvard Law School and Georgetown. So he has a lot of experience lecturing not only adults, but also students. And I think he's probably also feared by the financial industry, and that's, I think, what makes him so influential. And we're looking forward to a feast of he has learned during the last 8 years in his job, and there will be Q&As at the end of this talk. Thanks, Dan.
Thank you, Marcus. Thank you, and good afternoon, everyone. It's good to be back at Princeton. I actually spent a semester teaching here way back in the fall of 2004, from which I have a couple of vibrant memories, one of which is being the only person over the age of 22 on the dinky most afternoons, and the other of which is sitting in splendid isolation in my apartment watching the Red Sox win their first World Series since 1918, which I was unable to share with anyone, except there were some Princeton kids, obviously, from Boston, because as soon as that last pitch was made, I could hear the whooping outside as well. Tomorrow's my last day at the Federal Reserve. So in this, my final official speech, it seemed appropriate to offer a broader perspective on how financial regulation changed after the crisis. And in a moment, I'll offer a few thoughts along those lines. But then I'm going to address in some detail the capital requirements we've put in place, including our stress testing program. 8 years at the Fed has only reinforced my belief that strong capital requirements are central to a safe and stable financial system. It's important for the public to understand why this is so, especially at a moment when there is so much talk of changes to financial regulation. Now, before I get into the body of my speech, I do want to let you know that the speech as I'm delivering it is a slightly amended text to the prepared text, which was already on the FEB website, I think. It's probably already been put on there. But, you know, the speech is already going to perhaps tax your patience a little bit, and I didn't want to blur the line between speech and disquisition too much. So I cut some of it out, but it'll all be online. Now, to understand the regulatory changes made in response to the financial crisis, it's useful to recall the circumstances, with which regulators and legislators were confronted. First, of course, was the sheer magnitude of the impact on the economy, which suffered its worst recession since the Great Depression. Second was the dramatic freezing up of many parts of the financial markets, risking successive waves of fire sales that would have sent asset values plummeting anew. Third was the rapid deterioration of financial firms. Hundreds of smaller banks eventually failed. Bear Stearns, Merrill Lynch, Wachovia, and Countrywide were all close to failure when they were acquired by other financial firms with one or more forms of support or assistance from the government. AIG was rescued directly by the government. Lehman Brothers did fail, which set off the most acute phase of the crisis. The impact of Lehman's bankruptcy seemed to confirm fears that failure of the largest financial firms risked the complete implosion of the financial system. This, of course, is the too big to fail problem. Government officials may feel compelled to save private financial firms with public, that is, taxpayer funds. Hence, the extraordinary government actions that followed, such as the injection of that public capital into all the nation's largest remaining financial firms following congressional enactment of the Troubled Asset Relief Program in the fall of 2008. These measures ultimately proved successful in placing a floor under the downward spiral of the financial system. But it was against the backdrop of the need for massive taxpayer-backed assistance to firms and to markets more generally that Congress and financial regulators developed their responses. The first, and to my mind, still the most important element of regulatory strengthening was to increase the amount of capital held by banks to ensure they remain viable financial intermediaries that could finance economic activity. In fact, this effort began as part of the emergency stabilization efforts in early 2009, when we at the Federal Reserve conducted a stress test of the 30 largest banking firms in the nation. Where we determined a firm did not have enough capital to endure a highly stressed situation and remain a viable banking entity, we required that it either raise equity in the public markets or take some of the remaining government TARP capital so that it would be adequately capitalized. By helping restore confidence in the financial system, the quick action in recapitalizing the banking system stands as one of the turning points in the crisis. From there, we pursued a strategy of gradually strengthening ongoing capital requirements. With a few exceptions, the approach we took from the fall of 2009 onwards allowed the banks to use retained earnings to build their capital rather than continually to have to go to the public markets. We also began development of quantitative liquidity regulations in direct response to the liquidity squeezes encountered during the crisis itself. The capital and liquidity regulatory efforts were well underway and known to Congress when it passed Dodd-Frank in the middle of 2010. So it's perhaps not surprising that the provisions of Dodd-Frank relating to capital set some important qualitative standards for capital regulation rather than addressing capital levels as such. Now, a law as long and wide-ranging as Dodd-Frank cannot be reduced to a single key premise or concern, accepting its general focus on financial stability and systemic risk. However, with respect to the too big to fail problem, I do think it fair to say, on the basis of both the text of the law itself and its legislative history, that a pivotal choice was to make, at least in the first instance, regulation of the practices and activities of large banking organizations the presumptive approach to taming too big to fail problems. That is, increasing the amount of prudential regulation of what the banks were doing was opposed to the alternative, which was much discussed at the time and would have been a structural approach. One such approach would have been something like the old Glass-Steagall separation of commercial banking from investment banking. Now, under this approach, Glass-Steagall prohibited rather than simply regulated certain activities in different kinds of firms. Commercial banks could not get involved in capital markets. Investment banks could not take deposits and do lending in the way that a commercial bank does. Another structural approach would have been outright size limitations, resulting in the breakup of some of the largest financial firms. Dodd-Frank does give regulators authority to require divestitures by firms posing risks to financial stability. But these authorities, which contain only the most general of standards, seem intended by Congress to be used only if the panoply of other measures in the legislation have failed to contain the too big to fail problem. So as I said, at least in the first instance, Dodd-Frank forgoes structural solutions, which might have been cleaner conceptually, but perhaps would have ended up being much more complicated as a practical matter. Instead, it imposes a host of restrictions and requirements. So we have counterparty credit limits, we have risk retention requirements, we have incentive compensation constraints, we have resolution planning requirements, and others. These new statutory measures were meant to and do coexist with the capital and liquidity requirements put in place by the Federal Reserve and the other federal banking agencies under their pre-existing authority as enhanced by Dodd-Frank. An important corollary of this basic approach was that Dodd-Frank requires that many of these regulations be applied in a progressively more stringent way to firms of greater systemic importance. From this perspective, then, it is not surprising that Dodd-Frank implementation has been a major undertaking, that banks and sometimes supervisors feel overwhelmed by the breadth of the resulting compliance efforts, and that there is some overlap among some of the regulations. This outcome was, in effect, the price of the largest banks not being subject to a direct structural solution, such as a breakup. Now, none of this is to say that Dodd-Frank got the mix of restrictions just right. To the contrary, it would have been surprising for such a major piece of legislation that was passed in the immediate aftermath of the crisis to have done so. Usually, a law like Dodd-Frank would have been followed some months later by another law containing various technical corrections, or maybe some that go a little beyond technical corrections. But partisan divisions prevented this from happening. And the novelty of many of the regulations adopted by the agencies, either in implementing Dodd-Frank mandates or under existing authorities, almost assures that some recalibration and reconsideration will be warranted on the basis of experience. So there are clearly some changes that can be made without endangering financial stability. Foremost among these are the various bank size thresholds established in Dodd-Frank or in agency regulations for the application of those stricter prudential requirements to which I alluded a moment ago. For example, as I've said for several years now, we at the Fed have found that the $50 billion in assets threshold established in Dodd-Frank for a bank to be considered systemically important and thus subject to stricter regulations was set too low. Similarly, the $10 billion asset threshold for banks to be required to conduct their own stress tests also has seemed to us too low. And the fact that community banks, which at the Fed we define as banks with less than $10 billion in assets, the fact that community banks are subject at all to some of the Dodd-Frank rules seems unnecessary to protect safety and soundness and quite burdensome for the very limited compliance capabilities of many of these smaller banks. Beyond the thresholds issue, though, are there statutory provisions or regulations whose substance could be adjusted to better match economic or compliance costs with financial stability benefits? Again, it would be very surprising if this did not prove to be the case over time. It would also, I should add, be surprising if we did not find areas in which rules needed to be strengthened in order to achieve financial stability goals, particularly as financial markets themselves change. Generally, I think it's still a bit early to judge the balance of costs and benefits of many of the new rules. And it's still somewhat difficult to determine, for example, what should be considered normal levels of liquidity or lending, insofar as the pre-crisis period was one in which high levels of both lending and liquidity proved unsustainable. Moreover, given the healthy increases in lending over the last several years and the record levels of commercial bank profits recorded in 2016, it would seem a substantial overreach to claim that the new regulatory system is broadly hamstringing either the banking industry or the economy. But there are areas where I think the case for change has become fairly strong. The Volcker Rule is one. During the debates on what became Dodd-Frank, former Chairman Paul Volcker offered a fairly straightforward proposal. No insured depository institution or any corporate affiliate of such an insured depository institution should be permitted to engage in proprietary trading. It seemed then, and it seems now, like an idea that could contribute to the safety and soundness of large financial firms. However, several years of experience have convinced me that there is merit in the contention of many banks that as it has been drafted and implemented, the Volcker Rule is too complicated. The approach taken in the interagency implementation of the rule focuses on the intent of traders in an effort to determine, for example, if proprietary trading or permitted market making is taking place. We had hoped that the use of various objective metrics would help us infer that intent, that is, whether the trader is intending to engage in a proprietary deal or is simply offering securities for sale to purchase and sell on all sides of transactions. But it just hasn't worked out well, particularly with 5 different agencies administering the rule. Achieving consistency has been time-consuming and not always successful. Moreover, the statute, by its terms, covers many community and regional banks that don't engage in much trading of any sort. So I think a different approach, such as concentrating on trading limits and on capital requirements, might usefully be tried, though if 5 agencies continue to be involved, this too may be a challenge. So with those general observations in mind, let me now turn specifically to capital. The history of financial regulation over the last several decades is in many respects defined by an increasing emphasis on capital requirements, and specifically higher minimum ratios based on a more rigorous definition of what constitutes loss-absorbing capital. This tendency can be explained by the fact that capital is a particularly supple prudential tool. As activity and affiliation restrictions on banks have been relaxed, and as the integration of traditional lending with capital markets has created new financial products at a rapid pace, capital requirements can prove a buffer against losses from any activities, even those not anticipated by the regulators. Now, no single measure of capital is sufficient to ensure an adequate buffer. Simple leverage ratios, and for those of you who don't know, a simple leverage ratio just takes the amount of capital the firm has, and for these purposes, let's think of capital as equity, and divides it by the total dollar value of the assets of the firm. That's why it's called a simple leverage ratio. Simple leverage ratios are a good check on banks becoming too debt dependent, but they encourage more risk-taking insofar as they impose the same capital charge for every asset held by the bank, no matter how risky. Standardized risk-based capital ratios implement the intuitively appealing notion that a bank's capital should depend on the riskiness of its assets. But the grouping of individual loans and securities into necessarily broad categories of risk weights, such as residential mortgages, can be arbitraged. And a firm holding lots of assets that look very low risk in normal times can be vulnerable if its total leverage is high during stress periods. A third kind of capital requirement is one that can be derived from an economic model. Models-based capital requirements can better distinguish among risks to some degree, and they can be made more forward-looking than static leverage or risk-based capital ratios. But to the extent that banks' own internal models are used, it's difficult for supervisors to monitor whether banks are intentionally or unintentionally running models that understate their risks. So in the post-crisis period, we've continued the previous U.S. practice of using complementary leverage ratio and standard risk-weighted capital requirements, though at higher levels and with more reliance on common equity. We have also added a stress test. We, along with some other jurisdictions that are home to banks of global systemic importance, have also applied capital surcharges to the leverage and risk-weighted requirements of such banks, of which there are 8 in the United States. The rationale for this feature, the capital surcharges, the higher leverage ratio and risk-weighted capital requirements for those 8 most systemically important banks, is that the potential negative externalities caused by the stress or failure of one of these GSIBs, global systemically important bank, warrant a higher level of capital. Graduated capital surcharges have the additional policy benefit of providing these firms with an incentive to reduce the size and scope of their activities so as to present lesser risk to the financial system. Now, the U.S. banking agencies, that is to say the Fed, the OCC, and the FDIC, based post-crisis capital requirements on historical loss experiences so as to require banks to have a capital buffer that could absorb losses associated with a significant economic downturn and still remain viable financial intermediaries. But our researchers, and here I'm talking about the Fed alone, like those at some other official sector entities, have been using more formal economic analysis to estimate the level of capital requirements that best balances the benefits associated with reduced risk of financial crisis and the costs of banks funding with capital rather than debt. A recent study by 3 Federal Reserve researchers concludes that the Tier 1, that's that highest level capital requirement, that best achieves this balance is somewhere in the range of 13 to 26%, depending on choices made on some key assumptions. By this assessment, current requirements for the largest U.S. firms are at but towards the lower end of this range, even when one takes into account the de facto capital buffers imposed on most firms in connection with the stress test. This assessment, when added to our original historically based approach and the methodology used in developing the capital surcharges, suggests strongly that a reduction in risk-based capital requirements for the U.S. GSIBs would be ill-advised. In fact, one might conclude that a modest increase in these requirements is indicated. On the other hand, it seems reasonably apparent that the standardized risk-weighted capital requirements put in place after the crisis, while necessary to deal in a more granular fashion with the risks in larger banks, are unduly complicated for community banks. I believe we should be moving toward a much simpler capital regime for community banks. Now, there's been much discussion of late of the leverage ratio requirement. And remember, just to remind everybody, that's just measure of capital. The capital is the numerator, total assets is the denominator. And this discussion has come from multiple perspectives. There are proposals to make a higher leverage ratio requirement either mandatory or optional for banks, which would then be relieved of risk-weighted capital requirements and many other prudential regulations. There are also those who have questioned the relative cost-benefit trade-off of the enhanced supplemental leverage ratio, which is the 2% surcharge applicable to all 8 of the U.S. GSIBs. Increasing the current, now to start with the first one first, the idea that why don't we just have a higher leverage ratio, and that can just be a simple approach to regulation, don't need risk-based capital requirements, don't need a lot of other regulations. So increasing what is currently the 4 or 5% leverage ratio requirement to, for example, 10% would certainly yield a very well-capitalized set of banks based on their current balance sheets. But one needs to look at the dynamic effects of such a requirement. Since a higher leverage ratio would also make banks presumably less profitable, and with the constraints of risk-based capital and liquidity requirements now lifted, they would be strongly incentivized to change the composition of their balance sheets dramatically. After all, with a leverage ratio as the only significant constraint, the regulatory cost of holding a treasury bill is identical to that of holding a junk bond in the same amount. To truly assure the safety and soundness of the financial system, a leverage ratio serving as the sole or dominant form of prudential regulation would probably have to be set considerably higher at a level, pardon me, where the impact on financial intermediation could be quite substantial. Now, as to the other discussion of the leverage ratio, That is the impact of the 2% enhanced supplementary leverage ratio on the 8 GSIBs. Our experience leads me to believe that it may indeed be worth changing, because I think we need to account for the quite different business operations of that group of 8 GSIBs, particularly those in the custody business. The complementarity of risk-weighted capital requirements and leverage ratios suggests that there should be some proportionality between the two. But with respect to those 8 systemically important firms, we have a sliding scale of risk-based surcharges, but an across-the-board 2% leverage ratio surcharge. In practical terms, the asymmetry is most significant for the 2 banks that are dominantly custodial and transactional in nature, rather than engaged in a lot of lending and trading. These banks have had the lowest risk-based surcharges of the 8 GSIBs. Currently, they're at 1.5%. But their leverage surcharge is 2%. And in traditional bank regulation, the leverage ratio will be somewhat lower than the risk-weighted ratio. But as you can tell, with the surcharges, at least for those 2 banks, there's been an inversion of that. Now, this is especially problematic for the operations of these 2 banks, since they quite prudently reinvest the various custody customer deposits they receive into safe and liquid assets. So I think it would be sensible for the banking agencies to consider altering the enhanced supplementary leverage ratio requirement so that it would be set with an eye to the risk-based surcharge and thus regain the traditional proportional relationship between the 2 standards. And I'll add, I give a specific proposal for that in the written text, but I started reading it over the weekend, and I said, there's no way I'm going to try to explain this thing during the talk itself. Raising the minimum ratios in leverage and risk-based capital standards, requiring that qualifying regulatory capital be truly loss-absorbing, and setting higher requirements for the most systemically important banks have been important steps toward the goal of a well-capitalized and thus safer financial system. But the stress testing system, begun during the crisis and continually refined since then, has been the key innovation in capital regulation and supervision and makes these other measures more effective. As the term suggests, stress tests evaluate the capacity of banks to absorb losses that may be associated with major economic adversity and remain not only technically solvent, but also viable financial intermediaries in the eyes of their customers, counterparties, and markets more generally. The stress tests are explicitly forward-looking in that they involve creating unlikely but plausible severe economic scenarios and then modeling the likely impact of these scenarios on bank assets and earnings. The Federal Reserve has tied the results of stress tests into capital regulation by requiring that bank capital distributions be consistent with maintaining viability in the event the severe scenario were to materialize. That is, dividends and share repurchases cannot bring the bank's capital level below the sum of minimum capital requirements and the amount of losses that could be sustained in the stress event. One virtue of stress testing is that it allows a forward-looking assessment of potential losses that is customized to the portfolios and business models of each bank while still being consistent across the banks. The Federal Reserve uses independent supervisory models to estimate losses and revenues under stress, both to achieve more comparability across the results for different banks and to preclude any temptation for banks to game their own models. This linkage of stress testing to bank capital requirements has been a good way for regulators to regularize exercise of their broad statutory discretion to set individual capital requirements on a bank-by-bank basis. Banks subject to the supervisory stress tests have generally found it to be their binding capital constraint. This is as it should be, insofar as stress testing is meant to help set capital requirements for when they will most be needed, that is, in a serious economic downturn. To serve its important financial stability purpose, stress testing must never become static. As the financial system evolves with the creation of new products and new correlations among asset price movements, the supervisory model must account for these changes. And as salient risks to the financial system arise, the scenarios that must test for these new risks. Apart from the inherent need for adaptation, though, there is one respect in which the Federal Reserve stress testing program is incomplete, and other respects in which it is still in transition from a crisis and post-crisis measure to a permanent and central feature of prudential oversight. The significant way in which stress testing is incomplete is that it has only limited features with which to assess the condition of participating banks from a macro-prudential perspective. For example, it generally does not directly take into account second-round effects of stress in the financial system, such as the possible fire sale of assets by financial firms that are in need of capital or funding, which will in turn depress the asset values of all other firms below the levels that the initial economic shock had caused. These kinds of effects, that is, the effects of the interactions within the financial system, are harder to model, but very important for a stress test designed to achieve financial stability objectives across our financial system. So the Federal Reserve has begun a research program to try to develop over the next few years sound macroprudential elements to incorporate into the stress test. The transition of stress testing from a crisis program to a permanent feature of prudential oversight is, as I say, unfinished. This is in part because the de facto capital requirements produced by the stress test haven't been fully integrated into other applicable capital rules. This is kind of an artifact of the sequencing in which these various requirements were put in place. Additionally, because the failure of one of the stress-tested firms to meet supervisory expectations for its risk management and capital planning processes can lead to what is called a qualitative objection to its capital distribution plans, firms and perhaps supervisors have at times placed more emphasis on these supervisory matters than on others. One of the features of the stress testing program that some banks have found particularly troubling is that it culminates in annual announcements of whether the Federal Reserve objects to each participating bank's capital plan, an event that still garners considerable investor and public attention. Now, it's certainly the case that this feature, that is the annual stress test followed by a determination of whether the firm's intended capital distributions would bring it below the levels we think are necessary to absorb losses and stress, and that qualitative assessment of their planning capacities. The fact that we could object to on either ground and thereby make them modify their capital distribution plans was intended to and has focused the minds of bank senior management on their capital positions, how much capital they have, and on their capital planning processes. Motivating management with the stress test was, I think, quite appropriate at a time when capital was needed to be built up and when serious shortcomings of pre-crisis risk management at many large U.S. banks needed to be remedied. To be honest, I was stunned in my first few months at the Federal Reserve to find out that many of these banks were unable to aggregate their total exposures to particular counterparties across the various parts of one of the very large banks in anything like a reasonable time. So it was that experience in the first stress test that we conducted on the fly in the crisis that led us to see how much emphasis we needed to place on the bank's own capacities to gather information, to have it at their disposal, and to use that information in their risk management and capital planning processes. Still, the question was always how long we would need this highly focused set of annual determinations. Several years ago, we took a first step to avoid a quantitative objection by giving any bank whose planned distributions would have brought it below the post-stress minimum capital levels a short time in which it could adjust its plan. So we had finished the stress test, give them the results, and if they could see that the results would bring their post-stress, post-distribution levels too low, they could modify the capital plan in just a couple of days, and then we would not have an objection to that modified capital plan. So it avoided the possibility of a public objection. Last fall, I previewed the board's additional thinking on this subject. One point was our intention to remove the qualitative part of the annual stress testing exercise for the banks that participated but that had less than $250 billion in assets, in recognition of the fact that these firms, whose business models were almost all straightforward commercial banking, had generally met supervisory expectations for capital planning and risk management. In that speech, I also indicated that the Board of Governors was considering a significant revision to our stress testing program. The proposal for what our staff has called a stress capital buffer would simplify our capital regime. And here I'm going to just pause for a second again for those of you who don't know the ins and outs of capital. Although, as I found with Marcus's students earlier, at least a lot of people sitting in this building or in Benheim do understand those, but I assume not everybody does. The way the capital rules read now, you have a minimum amount, 4.5% Tier 1 common equity, which every bank is required to have. That's kind of our sense historically of what's necessary for markets to regard the bank as viable. On top of that, there's something called a capital conservation buffer of 2.5% of Tier 1 common equity. That's not minimum. That means you can have your capital fall below what's total for the smaller banks of 7%. But if you fall into that buffer, your capital distributions will be restricted. And the further you fall, the more they'll be restricted. So you see, the idea is to husband the capital of the bank and make sure that you don't get as close to the minimum levels by having the bank reduce its distributions. Now, for the stress test banks, what this proposal for the stress capital buffer would do is to remove that 2.5% buffer that applies to everybody, and in its place put in a buffer that we determine in the stress test is the maximum loss that the bank could face during the hypothesized severely adverse scenario. So it gets back to what I was saying earlier. It customizes it for the particular portfolio of the bank, given the expectation of the hypothesized severe economic outcome. And by doing that, we now fully integrate our point-in-time capital requirements with the stress test itself. Now, because the capital surcharge on the 8 GSIBs is part of we add that to the 2.5% buffer, it's part of our regular capital rules. So the stress capital buffer approach would effectively add the surcharge to our estimates of the amount of capital needed under stress. The surcharges were put in place precisely because the material distress or failure of one of these 8 GSIBs would have an adverse impact on the financial system as a whole that's far greater than the impact on the financial system of the distress or failure of a non-GSIB banking firm, even a very large regional bank. Accordingly, GSIBs should face capital surcharges that compel internalization of those external costs. Now, if we go ahead with the SCB proposal, it will raise somewhat the effective capital requirements of those 8 GSIBs. This outcome is consistent with the analysis of the costs and benefits of capital requirements that I discussed earlier, as well as the rationale for surcharges. It's also consistent with the intuition that because Congress decided against fundamental structural measures to deal with the too-big-to-fail problem, we should err somewhat on the side of higher capital requirements for these firms. And indeed, I should note that there are some academics and others who continue to make a case for even higher capital requirements, and in some cases, significantly higher capital requirements. The inclusion of the surcharges would allow the Federal Reserve to relax some of the conservative assumptions that we currently make in the stress test without lowering the overall post-stress capital requirements for the 8 GSIBs. But at the same time, as we relax those assumptions, there'd be a modest decline in the effective capital requirements of the roughly 20 non-GSIB participating banks, when, as I hope and expect, the Board of Governors moves forward with their rulemaking implementing the SCB idea. So, adoption of that SCB idea would remove a bit more of the drama originally associated with the annual announcement of the stress test results. Because now what you basically get is your loss buffer, and then you have to watch that loss buffer over the course of the next year and just make sure that on a daily basis you're not going into it without restricting capital distributions. But there would still be a little drama left, particularly given the possibility of that qualitative objection, where the Fed supervisors conclude that there are significant enough problems with the capital planning process or risk management that they're going to deny, that we're going to deny the plan and look for a modification of it. Although the largest firms, unlike the ones under $250 billion, are not yet generally meeting all supervisory expectations around stress testing and capital planning, they have each made substantial progress since 2009. And I do mean substantial progress. The differences really are quite dramatic. Now, as I indicated before, it was not a good situation that some of those banks were in, so it was a pretty low starting point. But there really has been an awful lot of improvement pushed by our supervisors, but also generated at the instance of the banks themselves. With a few exceptions, the issues observed during recent cycles of the stress test are less fundamental than those we were seeing even a few years ago. So I think the time may be coming when the qualitative objection in CCAR, in that CCAR stress testing process, should be phased out, and the supervisory examination work around stress testing and capital planning moved completely into the normal year-round supervisory process, even for the 8 GSIBs. Now, having just described some good directions for the evolving stress testing regime, let me comment briefly on what I regard as some ill-advised ideas circulating in current policy discussions. One is to detach the stress test from any limitations on capital distributions. This would, in effect, make the stress test simply an informational exercise for supervisors and markets. The very virtues of the stress test that I recounted earlier would be lost, as we would return to using only general backward-looking risk weights. Of course, it would also reduce capital requirements for the largest banks, which may be one of the motivations for the idea. I've heard two arguments in support of it. One is that Congress didn't require that the stress tests be used to limit capital distributions, which is true. The stress testing provision in Dodd-Frank just says you have to conduct the stress tests. The other argument is that somehow it's an unacceptable encroachment on the prerogatives of bank boards of directors to limit their discretion to declare dividends or authorize stock repurchases. As to the first, while Congress did not call for stress tests to be used explicitly to assure adequate capital levels in banks, it did call for increasingly stringent capital measures as the systemic importance of banks increased. Moreover, as I noted earlier, Congress in the 1980s gave the federal banking agencies authority within their discretion to set capital requirements individually for specific banks. The second argument, that which says, well, bank boards shouldn't be constrained in making capital distributions, amounts to an argument that there should be no capital regulation. Even traditional capital regulation limited boards of directors of banks from declaring a dividend that would have taken the bank below minimum capital levels. And those who make this argument seem to have forgotten that some banks continued to pay dividends in 2007 and 2008, even as their situations became increasingly precarious, which resulted in what? The need to appropriate money from the public to put into those very banks. Another unwise idea would be to give the supervisory model to the banks. Some have argued that it's only fair to do so, because otherwise banks can't know exactly what their capital requirements will be. In fact, observation of the stress test results over time has given most banks a reasonable idea of the loss functions in the supervisory model. And the Federal Reserve has increased over time the amount of information we disclose about the stress test models. But there are very good reasons not to publish the model itself. In the first place, remember that this exercise is called a stress test. This is not a case of using a model to set a regulation that then stands on its own as a constraint and then testing to see if there's compliance with that regulation. There, the model is essentially the reason by which the regulation was set. But here, in the financial area, we're using the model to try to evaluate what might happen to the bank's assets under stress. If the bank has the model, it will be able to optimize its balance sheet for the day on which the stress test is to apply to it by shifting into assets for which relatively lower loss functions apply. But it can then shift those assets right back over the succeeding days or weeks. Thus, the test will give a misleading picture of the actual vulnerabilities of the firm. Releasing the computer code used in the model projections would repeat a serious error made a quarter century ago, when the then overseer of Fannie Mae and Freddie Mac, made public all the detail that in the model that it used in its stress test, for reasons that foreshadowed some of the arguments that we hear today. With the model in the hands of the GSEs, even a scenario of the severity of the 2006 to 2008 experience produced only mild losses for them. And of course, this result stands in stark contrast to the actual losses, which were sufficient to drive them into public conservatorship in September of 2008. In short, we should recognize that what might appear to be a reasonable transparency measure in publishing the models will in fact result in less protection for the financial system. Thus, if the model were to be published, I would suggest that the minimum required capital levels would need to be materially increased in order to take account of those gaming dynamics that I've just described. Now, much as I would have liked to touch upon the other important topics, such as the need for credible resolution mechanisms and for adaptable regulatory processes to respond to new forms of shadow banking, I can't go on any further. Otherwise, those kids who are handing in their senior theses today will have their PhD theses in by the time I would finish. I concentrated on capital regulation because it's the single most important element of prudential financial regulation. The new features of GSIB surcharges and stress testing help guard against a severe new financial crisis and contain the too-big-to-fail problem. As proposals for regulatory change swirl about, it's crucial that the strong capital regime be maintained, especially as it applies to the most systemically important banks. Neither regulators nor legislators should agree to changes that would effectively weaken that regime, whether directly or indirectly. It would be tragic if the lessons of the financial crisis were forgotten so quickly. Okay, so I thank you very much for your attention there, and I know I taxed your patience. So we're going to do Q&A. Sir? You want me to do it, or you want to call on people? Okay, I'll call. Well, wait a second. Why don't you call on people since it's Princeton, and that gives a sort of patina of Princeton to the whole thing.
So now we are open for questions. Yes, if you could go to the microphone.
Okay, there. I'm telling you, this thing does not work.
Wouldn't it be much simpler to restructure the banks into casino trading banks and regular banks, and then all the capital requirements and all the regulation would be much simpler? Also, if you would restructure the banks, as Walker said, the Federal Reserve Chairman, in the past, into regular banks and casino banks or trading banks, then would be easier for the Federal Reserve maybe to get interest rate in such a way that many of the senior citizens, many more people are older, would get their CDs at 4%, and the bonds will be better if we get into smaller banks and restructure it separately from the bigger banks. Is there a relationship there?
Yeah, so not just since the financial crisis, but years, I would say decades before, right, Mark? The narrow bank idea has been around for a long time, and that's kind of a variant on some of the ideas that you just recounted. This notion of, okay, suppose we require banks of different sorts to have quite different business models and to stay in their lanes, as it were. So you have consumer banks, so you have these narrow banks, you have investment banks. That's sort of Glass-Steagall too. You have these investment banks. And I would say, a couple of things about it. First, I don't think there's any question that it would make the supervision of those banks a less complicated affair. You would have specialized supervisors for the different kinds of banks, and they would be brought up in the supervisory system. And there wouldn't be some of the challenges that exist now where one supervisory team needs to understand risks in that institution, in their broker-dealer, in their commodities merchant, in their London branch, in the regular commercial bank, and everywhere else. But as with most other straightforward solutions, it probably underachieves in some respects and may have some costs in other respects. And here's the easiest way to think about how it underachieves. And this is when the Glass-Steagall arguments are made. Glass-Steagall would be a financial stability step. Well, it would certainly be a simplifying step. But remember what I said at the very beginning of my remarks. Who was failing in 2008? Bear Stearns and Lehman, among others. Bear Stearns and Lehman did not, they were investment banks, they were broker-dealers, they did not have commercial banks. There was no affiliation between them and a commercial bank. On their own, they were able to increase the level of stress in the financial system. And when Lehman did fail, it really was kind of the match that lit the very dry tinder of the financial system at that point. So just by separating things doesn't mean people stay out of trouble. My second example there is the savings and loan crisis, right? Those savings and loans had a pretty narrow business model. Their narrow business model, by and large, they were doing lending for home purchases. Some were a little beyond that, but that's what they were doing. But they got themselves in trouble by the funding sources that they were trying to get, and they were paying, in some cases, very high rates to try to get deposits to kind of stay ahead of the fact that they were having funding challenges. So again, a quite discrete business model, which in some respects looked about as traditional as banking can look, and yet it produced a crisis that, depending on the analyst, cost the taxpayers somewhere between $200 and $400 billion. So you don't avoid financial stability problems just by that segmentation. All right, what did I say on the other side? There may be some costs associated with it too. Well, I think it's the people who run big banks with lots of different components to them, so the quasi-universal banks, I think believe deeply that there are synergies, business advantages to having a big commercial bank, an investment bank, a broker-dealer on the same organization. The narrative you most frequently hear is they are able to do large capital transactions, large underwritings, for example, for very large firms, very large non-financial firms, because they have the capacity to underwrite it, they have the capacity to provide bridge loans as necessary, and they have a distribution network that can then disseminate in the primary and security markets whatever the issue has been. Now, I think pinning down those economies of scope, I think, is probably something that something that requires a little bit more of an alliance between industrial organization economics and finance economics than we've had to date, but it's a very, very worthwhile undertaking. But I think intuitively, even people who are very hard-nosed regulators have felt there's probably something to that. And so there's a little bit of, there's some sense of maybe would have some costs in using that kind of structural solution. And if we're going to have those costs and still may have financial stability problems from a set of S&Ls or from a Lehman Brothers, then maybe we're not getting that much after all. But sure, it's a debatable, and this is why the debate for structural solutions, whether size caps or business model, I think is probably going to continue because of what the gentleman led with, which was, isn't it simpler? And it's definitely the case, right? Things become simpler if you have a simpler institution.
Excuse me one second. Now, do you see that the Federal Reserve has any responsibility for many people retiring, that you should get higher interest rates?
Well, what we've got a responsibility to do is to try to approach as best we can the two mandates that Congress gave us in the Federal Reserve Act. One of those mandates is price stability, and the other of those mandates is promoting maximum employment. Now, promoting maximum employment obviously means having a healthy, functioning economy that should be operating more or less to the benefit of everybody, although we all know that in any actual economy, not everybody is equally profiting. So for us at the Fed, it's not been a question of some sort of disembodied preference for a particular interest rate at a particular level. It's been what federal funds rate policies will most efficaciously move the economy towards a condition of price stability, which we roughly define as around a 2% inflation target, and maximum employment. And that's really what we're trying to do. We're not trying to zero in on interest rates and say our aim is to get interest rates a particular place. Interest rates are a tool to achieve those broader aims.
Thanks. Two questions. One is I'd be interested in your thoughts on the rationale for capital for operational risk on businesses that are not conducted in the firms any longer. Mm-hmm. And the second question is what your view is of the lack of international standards for capital and liquidity and the gold standards that the U.S. G-SIBs are required to versus firms internationally.
Oh, okay, just on your first question, I want to make sure I understood it. When you said for operations they no longer have, are you referring to some of these Basel proposals that kind of use a historical average of operational risk loss and therefore could require firms to some degree to have op risk capital against something that they may have divested? Yes. Okay, all right. Now everybody understand the issue, right? So on the first, that is something still being thought about in Basel, and that we're thinking, our supervisors are thinking about as well. Capital and operational risk the metrics don't mesh together as well as they do for capital and trading risk or capital and credit risk. And so there's been a kind of extended effort to correct or to improve a situation that doesn't appear to have been optimal over time of the way in which operational risk is calculated. And so one of the approaches has been to say, well, maybe a way to do this is to kind of let the past to some degree be prologue by using the historical operational loss experience of a firm as part of what makes up its ongoing operational risk capital requirement. And I guess, that makes some sense, I guess, in the same way that any experience may inform what some future risks will be. But it does lead to this issue and a few other kinds of issues that the banks and others have pointed out to us. So I think people are still doing the analysis of, okay, how much of a weight should there be, and might there be a way to, in a more or less clean fashion, say, pardon me, we really don't have anything like this business anymore. I think the problem comes, these Princeton things are great, except the water doesn't really come out sometimes altogether. I may go to Princeton Township water here in a second. Thanks. So the issue there would be, can you do something that's defined well enough that the bank has really gotten out of the business, as opposed to saying, hey, we don't have that portfolio that created all those problems anymore. I think that's the issue. Your second question was on so-called gold plating. So you sometimes hear criticism from some banks. Gee, there was this Basel agreement that the US, among others, reached, but then they came home, and when they incorporated that agreement into US law, they didn't just write it down, they actually put some additional requirements in there, or they upped the amount of capital that was required, or disallowed a particular asset class as being a highly liquid kind of asset. And some banks will go further. So you shouldn't do that. Well, responses to that are several-fold, I think. First, Basel, since its inception back in the 70s, and since the first time it did a capital standard in the late 80s, has been very explicit that it sets minimum requirements for all internationally active banks. Not maximum and not purportedly standardized. And so if you just think realistically about an international dynamic, we are able to get, we've had a fair amount of success actually in getting people to agree to some minimum standards, but realistically it means it's kind of the lowest level at which everybody could agree, because it's got to be unanimous. It's not a vote. It's not a majority vote. You've got to get everybody to kind of agree. So it's not surprising that some of those standards will be below what we, and importantly, our counterparts in other jurisdictions often feel are the optimal standards. And thus we and the UK and Switzerland and a number of, and quite a few other jurisdictions have put in place domestic requirements that are higher, or in some cases just different from the Basel frameworks. And I think from our point of view, well, first let me say something else, which is I think it's our obligation in acting under delegated authority not to just take whatever is done in Basel anyway and say, oh, that's the US reg. I think we have to think about it in the context of the US economic, financial, and legal systems. So we go out for notice and comment, and we end up with a regulation that's a US reg, not simply an echo of an international standard. Okay, then my last point on that. If you look at what has happened since the crisis with financial systems around the world, is the financial system of any large economy that has a lot of capital market activity sounder than this one that we're in? No, it isn't. And how are those banks doing? 2016 saw record profits for the US banking industry. Okay. Price to book, all right? Before the crisis, it was 2, okay? It was based on a lot of stuff that wasn't sustainable. In 2009, it was down to about 0.5. Okay? Today, it's about 1.5. And you contrast that with some of the other jurisdictions in which capital requirements have not been as rigorous, and you see lower price to book. Our banks have been getting stronger. They are stronger. They're able to do business. The counterparties know it. They have been prospering. Now look, we are still we're in a long extended recovery from the most severe economic downturn since the Great Recession, and one in which is sort of catalyzed a lot of other changes in the economy. And so I don't think we're yet at that much vaunted new normal, which will probably be even better for the financial institutions. So I think we've got to remember that being sound, well-capitalized, having good and solid funding sources is a source of strength for U.S. banks, and they are perceived as such. They are perceived as strong. So I don't think there is as much inconsistency between the idea that we need to have strong regulations in order to forestall another financial crisis. And a lot of people, why worry about another financial crisis? Well, we should worry about it. But I don't even think that that's inconsistent with having a well-functioning system of financial intermediation. Lending has been growing at over 5% for the last couple of years, well above even nominal GDP growth. It's, you want to go back to 10% lending growth? That was 2005. What do we think? What do we think of some of that lending that was taking place in 2005? So there's, we've got to recognize that we want sustainable lending. We want strong financial institutions which are able to support the credit extensions that households and businesses need in the United States, and that it is it's not inconsistent to have financial stability objectives and a strong and growing economy. And I will say, I think it probably is going to result in fewer spikes up and down in both directions.
Thank you for speaking with us today. As you know, financial markets have only been up since the election, up over 10% since the election. So what do you view as the biggest risk to financial stability right now, if you had to pick one?
Well, okay, so let's be clear. When we talk about, I think you're probably referring to the stock market. And when I got into economic policy making many decades ago, a wise man once said to me, markets go up, markets go down. Don't pay too much attention to them at any given moment. So when we're doing financial stability analysis, what we look at when we look across a range of markets is two important things. One, whether the prices of important assets are notably in the high end or more dangerously beyond their historic ranges. But then two, how are those assets financed? Are they financed in such a way that you can have a kind of domino effect or not? So the mere fact that some asset class, including equities, may have risen substantially, in and of itself doesn't tell you very much about financial stability risks. But you asked a totally legitimate question, quite apart from that, what are the financial stability risks that I see? And I would say, right now in the United States, this gets back to my little sermon of 2 minutes ago, our banking system, our prudentially regulated banking system is really quite strong. It's quite resilient. It's resilient because of all this capital. It's resilient because the dependence on short-term funding of the largest institutions has been roughly halved since the crisis. Okay? So right now, while you never want to say there are no risks and all the rest, we are in a circumstance, I think, in which we can feel relatively good about the footing on which we've placed ourselves. And so there may be risks being taken by those who are outside the prudentially regulated system, which could have negative effects in the economy, but so long as that prudentially regulated system is itself strong, it's still the backbone of the credit intermediation function in the United States, it's where markets are made and the like, then we are in much better shape than we were 10, 11, and 12 years ago. In terms of the things that I worry about, first, I worry that that's a transitory situation in and of itself. So in the next 24 hours, I'm not too worried about it changing. So I'll be out of the Fed by the time this becomes an issue. But new asset classes and new funding approaches may be developed. And just as, all of a sudden people turned around and subprime securitization was threatening to bring down the economy, something like that could develop quite quickly because we do have the, people do have the capacity to make these things happen. And when money is being made somewhere, boy, do people get in there in a hurry, right? So that's the sort of the Council of Vigilance, which is easy to say, but you actually have to do it. And we at the Fed and the Treasury and others have tried to put in place some formal monitoring systems to try to assess this thing as it happens. And Marcus is one of many distinguished academics who's been trying to come up with metrics for financial risk, financial stability, riskiness and the like as well, all of which means there are more eyes on this than there used to be. Let me repeat something that I said yesterday, though, which is there are other risks. And I think right now, I regard the area where I think we need most focused attention by a variety of government and private entities going forward is in the area of cybersecurity. This is a whole different kind of risk, something that bank examiners are not as familiar with. It historically hasn't, the integrity of data has always been an issue, but not of the sort that it is today. And so that, there have been efforts, interagency efforts within the government for some time now, better to coordinate, establish standards, follow up on things. But I think this is and a lot of firms have been spending a lot of resources to that end as well. But I think this is an area that's going to require sustained attention from banks, from non-bank parts of the financial system, from regulators, from law enforcement, and really a much broader set of actors in the U.S. government.
I think we have 5 questions left. Perhaps at some point we have to bundle them. Let's continue here.
So thanks again for coming. What are your thoughts on Jeremy Stein's proposal of keeping the Fed's balance sheet large in an effort to crowd out short-term private sector wholesale funding?
Yeah, I think so. Jeremy's proposal, and there have been some variants on it, is one way into thinking about the relationship of monetary policy and financial stability. And so if I can just rehearse for you the sort of standard way I hear this play out with my colleagues who have been macroeconomists since grad school, it kind of goes something like this. Well, we shouldn't use monetary policy as a financial stability tool. We should use monetary policy to achieve price stability and maximum employment. So then the counterpoint is, well, yeah, but wasn't that the problem back in the 2000s where inflation was quiescent and employment was in pretty good shape, but all during that period we're having the buildup of these assets whose values are unsustainable. And you go back to the other side and the argument is, well, yes, but one should use other instruments, supervision, other forms of regulation, to, in a more targeted fashion, go to the source of the financial stability problem, not raise rates in an effort to staunch some sort of asset price inflation, which will turn out to be a bubble, and which, because of the way it was funded, will turn out to have a problem. So then the debate tends to become, are there cases, and if so, how likely are they, in which those kinds of instruments are either conceptually or more likely, in practical terms, not available to either the central bank or to other actors in a particular economy? And if the answer is you can imagine such instances in a less than fanciful way, then you have to start saying, well, might it be appropriate to use monetary policy in an effort to dampen asset price inflation in some circumstances? So the proposals that Jeremy and others talk about are sort of a variant on that, because what they're talking about is maybe trying to use the Fed's balance sheet to allow short-term rates to be set in accordance with the the dual mandate of the Fed, but to use sales and purchases of assets from the Fed's balance sheet to have a desired dampening effect on longer run rates. That, it's out there as an idea which I think is probably can and should be debated in this broader discussion of financial stability. The only thing I'll say is I think that, first off, I think there's a lot of, it's intellectual, it's a very stimulating road into thinking about financial stability. But I think, if you understand the mind, and I'm not characterizing my current colleagues on the FOMC, I'm just talking, I spent enough time in Basel seeing central bankers from all around the world, and I think central bankers, no matter whether they're more inclined to be more hawkish or dovish in some monetary policy respects, I think they tend to have a bit of conservatism when it comes to things like the balance sheet, setting monetary policy. There's worry that if you try to do new stuff, you might end up messing up your primary tools and what you're trying to achieve with those primary tools. And that's probably the reason why things like quantitative easing come to us in crises as opposed to in sort of normal times.
Gentleman here.
My question is along the line of the first question earlier, namely structure or other things, but I will emphasize on really what was the cause of this 2007, 2008 bubble. Now, first, there are other countries which fared very well, notably Canada and other countries. So what are really the things that they can do that we didn't do, or what we are going to do will prevent that from happening? And my second point, or really a question is, recently there was a conference in this university talking about the same issue. One of the things the speaker, an academic, he made a point. He said there are certain cultural elements in our society which will make this thing, certain things which a government cannot really control. His point is the housing bubble, why it bubbles, precisely because the borrower have no savings whatsoever. So how do you think this is an important element in the bubble?
So, with respect to the first question, there were parts of the world where the banking systems didn't come under the severe stress that they did in the US and the UK and some other places. That is true. That is true, but that doesn't mean that they might not, and that some different kind of crisis might not afflict them. If you look at the academic work on banking crises, you'll see how many banking crises there have been over the last 50 years in very different kinds of jurisdictions with very different banking structures. I do think it's the case that our particular crisis had a lot to do. Its origins lay to a considerable extent in the progressive integration of traditional lending with capital markets, which led to the availability of a lot of short-term wholesale funding that was then channeled into lending, which was then securitized, and the various links and checks and points of underwriting integrity and the like that have been associated with traditional lending had been attenuated or sort of dispensed with entirely. So that, those symptoms, those features of the economic system, financial system as they existed 10 or 12 years ago, were something we needed to address. But that's not the only way that you can get into a banking crisis. The banking crises with, Sweden had a banking crisis, and their banking crisis didn't have anything to do with the securitizations and the like. It was just sort of almost looked more like our savings and loan crisis and the fact that it came about conventionally. So I think all of us, and you know, talk to the regulators from some of these countries, they do not, believe me, they did not spend all their time going around bragging, saying, hey, you know, we got the answer here. They were all saying, yeah, we escaped this one, but we still got to be careful about what is going on here. And I think it's just incumbent on everybody to see what the risks are in their own system at any particular time.
Yeah, so if you look through the Fed's transcripts in 2008 and 2009, you learned that the Fed expected large losses at these banks that weren't recognized on banks' balance sheets. So I guess my question is, why didn't the Fed have banks recognize these losses pursuant to like Section 121 of fiduciary or something, and that would have forced them to recapitalize contemporaneously as these losses were happening? And just to give a sense of what the magnitude of this was, I think it was the August 08 FOMC meeting. Ben Bernanke had like a baseline estimate of what losses at the 5 largest banks, commercial banks, would be, and these numbers were actually in excess of what the May 2009 quote-unquote more adverse scenario losses projected to be.
Well, but wait a second. I'm sorry. Start your question over again, because I think I thought I knew where you're going, and then I lost you.
All right, sure. So I mean, the simple idea is the Fed estimated that banks had large losses on their balance sheets that were not recognized, increasingly so throughout 2008 and early 2009. And had these been recognized on time, and the regulators have the authority, and you could argue the requirement under fiducia to recognize these losses in a timely manner, they would have been forced to raise equity, because throughout the entire
They would have been
forced to recapitalize privately.
Oh, yeah.
I mean, throughout the entire crisis, banks always raised what they actually lost, but they didn't record.
Right. Okay. But so a couple of things here. First off, another argument for stress testing, right? Because this is exactly what stress testing does. Stress testing now on a regular basis says, let's hypothesize a severe scenario and see what the losses are. And we are not going to pay attention to the accounting issues of whether something is in the banking book and thus doesn't need to be marked to market, or whether it's in the trading book or the available for sale category in which it does need to be marked to market. We are just going to require that there be the capital sufficient to serve as a buffer to those losses. I think that's probably the most important point. It's the dynamic of the stress test gets you in that direction and makes sure that something is not, the potential losses don't depend upon whether something is denominated banking book or trading book. Second, and now I wasn't there in August of 2008. And so I don't want to project what people were thinking and why they were thinking it. But when you say to yourself, force banks to recapitalize, you do have to ask, what is the environment in which you're forcing them to recapitalize? And is this something which would be realistic for them to achieve? And so, just ask yourself, you wouldn't have been investing 8 years. I don't think you're old enough to be investing.
Definitely not. Well, Citi was trading at $80 billion a month after Lehman failed. $200 billion at the end of 2007. It seems like they could have done a discounted rights issue or something, and it's inconceivable that they would have been unable to raise, provided that they had recognized the loss and they were.
Well, I'm not going to do the retrospective on a set of policy decisions that were made when I wasn't in the government. But I think, from your point of view, the important point going forward is the stress test itself is an instrument that achieves the end that you're looking for, and actually, it's better than that in some sense, because it tries to make sure that the bank's capital doesn't start eroding down to that number. It is the dynamics of this and seeing what losses could occur that distinguish the stress test from the point-in-time capital requirements and actually get you out of the debates on interpretation of fiducia, which, you're quite right, were raging for a period there in the 08-09 time frame as well. Okay.
Thank you for hearing me. My question deals with the relationship between the capitalization rate, the funds lending rate, and the loan rate that businesses see at the bank. My experience has been that even when the Fed rate was at its lowest, they were having difficulty securing loans. And I don't know whether that was because of the changing in the capitalization rates that the banks were experiencing, which in turn means that they need to charge, or their rules are more stringent to businesses looking to secure loans. If there is a relationship, is that something that the Fed takes into account when it's discussing monetary policy?
So when you think about availability of loans, the first thing, if a bank doesn't do this already, our examiners will be in there making sure that they do. The first thing to think about is the creditworthiness of first off, somebody needs to want a loan. And secondly, if they want the loan, they need to be creditworthy, right? Or at least creditworthy enough so that the interest rate and other terms that can be put in place give enough of a prospect of being repaid that, considered over the class of similar loans, this seems to be a prudent activity. And I think, during much of the period in which rates have been low, my continued experience in talking with bankers and businesses and looking at the National Federation of Independent Business surveys has been that the principal problem was demand for loans was pretty weak. Businesses were not wanting to expand. And so you had a situation in which many banks would say, we've got money to lend, but the people who want to borrow from us are people who are trying to cover losses, not doing investments in new productive capacities. And so I think that the way in which the level of rates moves through into the actual amount of lending is something that's it's not just affected, obviously, by the level of rates and the inflation rate and the real interest rate and all the rest. It's affected by the demand for loans and the creditworthiness that's judgments that are being made by the banks.
Okay. Yeah, it seems like the basic assumption underlying a lot of this regulation is that banks have an incentive to get over-leveraged. So I guess the question is, do banks have more of an incentive toward leverage than other firms? Or?
To leverage than other firms? Yeah, I think they do.
If so, why?
Sure. In part because they can. Okay. That is a lot of the reason why they have that incentive, is because they can do that. And in a sense, it's the business that they're sort of in, right? But to take a very conventional bank, okay? What is a very conventional bank? What does it do? Well, we all think, it makes loans and it takes deposits. The deposits are a reasonably inexpensive form of funding under a lot of circumstances, particularly with the FDIC backing them, so they tend to be a fairly reliable kind of funding. But there's something else going on there, which is the bank is providing transaction services. And so it's basically using the combination of its leverage and its lending to create transaction accounts for people. And thus, it's sort of performing an economic service precisely as it is leveraged. So that's clearly it's a good economic reason for having this kind of financial intermediation. And then the question is, how much leverage do you want to allow there? I think so the incentives to leverage are going to be high for any economic actor if the individual thinks, I got very high upside possibilities here. Because if I think I have very high upside possibilities and I can borrow a whole bunch of money, but I own all the equity. If it turns out I make all this money, I get all the profits. And if it turns out I lose it, it's my creditors who lose the money and not me. Right? In most businesses, the banks themselves will not provide credit, will not provide leverage beyond a certain amount. And so the incentive to leverage, it should be widespread. It shouldn't be limited to people who are just in finance. The difference is people in finance can leverage. And they can leverage in part because of deposit insurance. They can leverage in part because of these very short-term contracts that have people saying to themselves, we can get out quickly so we're not worried about the amount of leverage that they may have. There are a variety of reasons why financial intermediaries, at least some forms of financial intermediaries, can have higher amounts of leverage. The public policy question is, for us, what is the amount of that leverage which is consistent with a well-functioning financial system? And that doesn't mean a system that has no risk in it. It's got to have risk in it, right? The question is how much and where do you want it? Okay? All right.
Thanks a lot, Dan Tarullo. This was a splendid talk, and I see you next time.
We are dismissed.
Thanks a lot. It was
Okay,
great.
thank you, Marcus.
And let's stay in touch.
Yeah, oh yeah, absolutely. Good. All right, thank you, Marcus.